Welcome back to the Group Practice Accelerator podcast, brought to you by Polaris Healthcare Partners, where we leverage decades of healthcare and business experience to drive growth in successful group practices just like yours. If you're a healthcare entrepreneur and you're interested in building, scaling, or exiting your group practice, you've found not only the industry's leading resource for business education, but a team of trusted advisors dedicated to helping you achieve and exceed your goals. In short, the team at Polaris creates clarity, confidence, and results. I'm your host, Jamie Falash, and the Group Practice Accelerator podcast is on the air. Hey everyone, thanks for joining me today for another episode because we've got a topic lined up that we just don't spend enough time talking about, in my opinion. So, quick check-in. How many of us can say we truly understand credit, and specifically how it relates to growth capital when we need it? Yeah, my hand isn't raised either, and I recognize it's not because we don't have a good handle on our finances or because we're not well-versed in our credit scores. And I'll be honest, although I was never a mathlete, I thought I was pretty well educated where finance is concerned. But recently, we got a couple of listener questions that prompted a more in-depth discussion here at Polaris. And as it turns out, there's a bit more to understanding credit than I thought. But thankfully, and not coincidentally, our founder and CEO, Diwakar Sinha, comes from many, many successful years in the banking industry. And he's going to guide us through some of the things that we need to be thinking about in terms of credit, including why sourcing the right debt capital is really important. Diwakar, welcome back to the show.
Thank you for having me.
So in preparation for our discussion today, you sent me a My FICO booklet. And, it's pretty basic. It runs through some things. It's the most non-sexy education I've ever received. But it kind of takes you back to the foundation of how scores are calculated. And I think it's a good thing to share. I might put it in the show notes for everyone to take a look at. But you've got a ton of experience in this. So can you walk our audience through some of the elements of this? And maybe a good place to start is talking about how credit is calculated and the types of credit.
Sure. Yeah. So I think just for the audience members, I think when we think about credit scores, we think about the three different types of credit scores. First of all, there's Experian, Equifax, and TransUnion.
Mm-hmm.
So I think those are the three things to think about out there. And when we apply, most of us are used to thinking about applying for a mortgage, applying for a car loan. We might have gone for a practice loan. Most of our audience members own medical dental practices, and we've applied for a business loan. And so they might have had a bank pull the credit scores, Equifax, Experian, or TransUnion, or they might have heard the bank pull all three scores. And in the commercial lending world, it's called a tri-merge. Means the bank pulled all three credit scores and merged all the three scores. And usually when they do that, they pull the middle of all three scores. So in some cases, the middle of all three scores could be TransUnion. The middle of all three scores could be Equifax. The middle of all three scores could be Experian. So really what the bank's trying to do is mitigate risks and look at the middle of all threes. Some banks may use Equifax as their dominant scoring model. Some banks may look at Experian as their dominant scoring model. So different institutions have different scoring models as their risk profile within their credit model, and that's going to dictate it. And some banks may say the middle of three as their scoring model.
So it's an average of three. It's the middle.
Could be the middle of three, could be the average of three, but usually it's the middle of three, or they'll use a scoring model saying, okay, we're going to look at all three, but then we'll use Equifax or Experian.
Okay.
They'll look at all three to get a broader profile of their client, meaning they'll say Equifax is our dominant scoring model, but we want to look at Experian and TransUnion to see how they're paying different things out there. So they're trying to get a bigger picture of the person to make sure that that person is paying things on time and how different models are being looked at. But they're going to look at their dominant scoring model. That's how the bank dictates credit risk. And within that, again, all three models will look at open, revolving, and installment.
Okay.
As the three different things of credit. So open is essentially a credit type that has no credit limit. Okay. And the most common, and I'm not promoting the brand, we're not sponsored by it, is American Express. American Express is a credit type Well, one of the credit types American Express offers, American Express does have a closed type of credit also. American Express is the blue credit card, which has a closed credit limit. But American Express, the green one or the gold one or the platinum one or the black one, essentially does not have a credit limit, is an open limit. Means you don't have a credit limit, and that means an open. So if you pull your credit report, it's going to say Amex and it's going to say O, and O means open credit type. Okay. And that's
Uh-huh.
essentially you have to pay off in full every single month. The next type is called revolving, which means you have a credit limit. So you might have a Capital One or an American Express or Chase or different types, or even a home equity line of credit. People don't look at home equity lines of credit as a revolving. Okay. That is essentially has a limit that has, you can carry some balance on that you would pay down or pay off every single month. Okay. And that's called a revolving line of credit. Okay. Essentially, any line of credit, business or personal or home equity, would be considered some type of line of credit. It's called a revolving line of credit.
Got it. Okay.
And the last time is a installment credit. That's a car loan, a mortgage, a commercial loan, which has an initial fixed balance, a monthly fixed balance, and at the end of it, through a period, you would pay it off to a zero balance. So anything that has a fixed payment and a zero balance at the end over a 10-year, 5-year, or 20 or 30-year period, that's considered an installment type of debt. Those are the three types of credit typically you would see.
Okay. And then, of course, your FICO scores are going to impact every single one of those types of credit. And then
Yes, and then also the age. I mean, so how long you've had credit is going to also impact. So the longer you've had credit, that's going to also impact how long you have credit. So if you'll see like as you pull your score, the age of your credit impacts your credit also.
that makes sense. What about a bankruptcy score? You and I talked about this just a little bit, but it was something I was largely unaware of. What is a bankruptcy score? Can you tell our listeners about that, please?
Yeah, so great question. So a lot of people, when they hear the word bankruptcy, their heart rate probably goes up a little bit because
Yeah, a little
they
bit,
think it's
I'm
they
sure.
think about things not performing or non-performance of things. And the bankruptcy score is used more in the commercial world, and it is an indicative score, a predictive score that gives somebody a commercial institutions a likelihood of somebody defaulting. Okay. And usually it has an inverse relationship to credit scores. Okay. So typically, the lower a credit score, the higher the bankruptcy score.
That makes sense.
Okay. So the lower the number, the lower the bankruptcy score, the higher the credit score. Okay. Now, that is not necessarily mean that. So somebody could have a 850 credit score, which is the highest credit score.
Yeah.
Okay. Doing things amazing. They could have a high credit balance. I mean, they're having high credit balances on their credit cards, and they could have a little bit higher bankruptcy score. Means there's some concern around them defaulting.
Mm.
Okay, so these are the smaller things people start to look at and start asking questions around. And in our future podcast, we can kind of go through some indications of how banks think about it. And these are the kind of things when we source capital for clients, we start asking questions around living expense, questions around spending patterns and cash reserves and things like that. And when we have talked about people putting in 6 months of capital reserves or cash on hand, that we want people to start thinking about within their business. But that's what bankruptcy score essentially does, is allows commercial institutions and commercial banks to kind of think about a predictive basis of a forward looking within a client's cash flow profile.
Well, and that kind of ties into what I wanted to ask about debt to income ratio. So let's say you've got a great credit score, but you're using all of that credit. Let's talk a little bit about that ratio for consumer debt first. Can you explain that?
Yes. So I think when people go apply for a mortgage, they might have talked to their mortgage rep, and the mortgage rep might say, well, your debt to income ratio is in line or your debt to income ratio is high. And what they're trying to say is, for let's say you're making $200,000 in personal income as a provider, and most mortgage companies have a debt to income ratio of 30% to max 40%. And so 30% means that they, on $200,000, your maximum debt level can be 30% of $200,000.
Okay.
Okay. So that would mean in this case, roughly around $60,000 is your maximum debt level. That's $5,000 a month. Okay. That means when they leverage your mortgage payment, which is, let's say, left for you $3,000 a month, plus your car payment of, let's say, $1,000 a month, that's $4,000, plus any car insurance and cell phone expense and all these things. The max they can take it up to is $5,000 a month.
Okay.
Okay. So that's what they're trying to take it up to, which is 30%. Okay. Because above that, if you're making $200,000 a year, they're having to take off for taxes, they're having to take off for living expense, and they're having to take off for all those things within that. So they're trying to not burden you past the $5,000 a month to make sure you can still comfortably pay your mortgage expense and everything else within your lifestyle. So that's what debt to income ratio means on the consumer side. On the commercial side, they start looking at your commercial loan expense plus your personal living expense. That's called global debt service coverage ratio. But that's on the consumer side, what they're looking at is on that side.
Okay. Well, and that obviously plays into the risk for them. If you're above that 30% and they're not wanting to max you out, it's to their benefit to not have you maxed out on what your bills cost you every month. It changes the whole risk profile. Can you also talk a little bit about how banks look at business debt for practices? Let's relate this back to our audience. And then how they look at consolidated debt, meaning why do some banks look at debt differently than others, or some types of debt differently than others?
Yeah. So the way banks look at business debt for practices, they're looking for you'll hear these terms called what the bank's looking for: business cash flow of 1.25 or 1.35. And what the banks are looking for is for every dollar in business debt you have coming in, they're looking for a positive cash flow after all your personal expenses. We just went through personal debt coverage ratio to have $1.25 or $1.35 in positive cash flow.
Okay.
Okay. So let's say in this case, we just talked about the $5,000 a month in personal expenses. So that's already been covered.
Okay.
Okay. Now we're going towards the business expenses. Okay. So if you had $100,000 loan payments to the bank is now saying, after all taxes being paid out there and everything like that, we need to have $1.25 or $1.35 in income coming in. So that means $135,000 in positive cash flow needs to be coming in for every $100,000 in loan payments going out. It's a simple formula, but there's a complex calculation we have to do to make sure that that is actually happening. We have to look at living expenses within the business. So we have to say, okay, if our doctor is and the household is making this much money, how much income do they have to be making? How much cash reserves do they have to be able to support everything within the business? Okay. So we have
Okay.
to look at, so when we, source capital for our clients, we have to look at all these calculations. The banks are looking for this because the banks are going to say, well, if you have all these cash reserves, how come the business doesn't have this cash liquidity position? So these are
Legitimate
all the things
question.
we have to look at all these things. And then the second part of your questions, why do some banks look at real estate debt, as part of the business and some don't? The banks that understand middle market debt, they do separate operating business debt from real estate debt. Banks that don't understand middle market lending or are more on the sub $3 million lending space consolidate real estate debt with it. Unfortunately, that's how it is.
Okay.
And that's really the space, that a lot of clients that call us above the $3 million lending wall that typically we see, to maybe $4 million lending wall we typically see. That's because the banks will consolidate or look at everything as one exposure, the real estate debt with the operating debt as one exposure, and they'll combine everything into one. Starts to create challenges for the relationship with the client, and they'll call us and say, hey, you know what, I'm trying to grow. I'm having to go for every practice as a one-off relationship, and they'll call us, and then we'll end up sourcing a true middle market relationship for them, where the middle market relationship will separate the operating company debt from the real estate company debt. Some banks will still cross collateralize, some banks will not cross collateralize. That said, they'll truly separate and say, you know what, we're comfortable with the $3 or $5 million real estate debt because it's collateralized by real estate. It's going to require some level of down payment, and the operating debt is going to be true operating debt. Now, there's going to be still reporting requirements that the client still has to meet every year. That's very important. Middle market debt reporting requirements are a lot tighter, okay, that we want to make sure our clients understand.
Okay.
That said, if you meet the reporting requirements, you can still get a lot of capital out there.
That makes sense. You mentioned something about how different banks view these two differently, but why can some banks make those loans and some can't? What's the
Yeah,
deciding factor?
I mean, I'll give you one example. One bank, without going into specific names, looks at in their financial calculation, personal living expense as a calculation.
Okay.
Okay. And so, for example, when they're calculating debt service coverage ratio and somebody's making, let's say a group practice owner is making $400,000 in cash flow out of the practice. Okay. Typically, most banks will say, okay, personal living expense on $400,000 is 15%. Okay. So that would be $60,000 on $400,000 in living expense. Okay. Or, in that. So one bank will calculate that and say, okay, we've calculated that in there and our cash flow requirement's 1.25. Okay. Another bank will say, well, we're not going to calculate that in our living expense, but our cash flow requirement's 1.5.
That makes sense. Okay.
Okay.
Follow.
But we don't know how they're looking at that 1.25 to 1.5. And now you don't know which one's a better cash flow requirement.
Right.
So we have to calculate and say which bank is the better solution. So if the client doesn't know which one's a better solution, they might have gone to the 1.5 bank, gotten a decline, where the better bank would have been the one with the living expense calculation, and the 1.25 was the better solution. And that's what a lot of people experience in the market is that they don't know how one bank has a better calculation method versus another bank.
I'm already grateful for your experience in this whole banking world. So, in relationship to that, there are different policies on lending. What are some of those differences in policies, and how do you know the difference? Let's talk about your experience there, and because of course that's going to help our audience members that are looking to raise capital. So let's dive into that a little bit.
Yeah, so I mean, first of all, I mean, I was in credit for about 17 years on the banking side,
Mhm.
so I have a fairly good idea on how lending credit policy should work. We end up knowing the back end credit teams of a lot of different institutions. We run a fairly broad process to source the right capital solutions. We do negotiate the covenants and terms for a lot of banks, so we know what covenants should matter to our clients in the
Okay.
market. So we tend to negotiate that in our process. The process takes us about 3 to 4 months to source. It's not a quick process. So we do want to temper that expectation. At the same time, the right capital is going to take some time because we want to source that capital and make sure our clients put in the right solution. As I said, the covenant reporting processes are cumbersome, but once you have it, it's there for you for the next 3 to 5 years, as long as you can continue to meet those growth requirements. And
Okay.
it's there. As far as how do we know the lending policies out there, and we when we underwrite ourselves, so we have obviously our own analytics team, we underwrite ourselves. We're able to go to different institutions, compare our covenant underwriting, and say, okay, how do you guys look at this requirement? And they underwrite and look at our process and say, okay, we agree with your math, or here's where our math looks like. So when we run our process, we'll run with 5 to 20 different institutions out there that are national and compare our process and see how they come back with their covenant reporting requirements. We'll negotiate with them and we'll go to our clients with 2 to 5 different term sheets and be able to source that process for them. So I think by the time we come back to our clients, they're able to get the best of everything in the market, either locally in their market or nationally from a mid-sized bank to a large-sized bank.
Okay, so we talked about the importance of sourcing the right debt capital, and thanks for going into that for us. And I envision this as you and I talked about a little bit prior into looking at the right mortgage, like what's the right structure. And I think to do that, we have to understand the market cycle, which we do. But can you talk a little bit about what growth options make sense and relate that back to the market cycle as well?
Yeah, I mean, I think coming out of 23 and 24 right now, cost of capital is starting to come down a little bit in the market. We're going to continue to see some level of softening in pricing out there. So I think people are positioned really well to kind of take advantage of softening in pricing.
Mhm.
So I think securing capital, and the right, positioning themselves is a great solution to sourcing the right capital structure. And if they're thinking of growth, they have two solutions, right? Is to get either a form of debt capital and continue to grow that way, or bring in equity capital. And both are great solutions. I mean, I think that the 2025, the equity markets are great. We have a lot of clients looking to bring in strategic partners in 25 and 26. So if you're looking of growth and want to bring on an equity partner, that's a great process right now. Or if you're not looking to bring on a strategic partner right now and want to grow through debt, and then in the next 2-3 years bring on a strategic partner, that's still okay. But I think as far as the purposes of bringing on debt, I mean, the next 12 months to 24 months, I think the pricing conditions are going to be really attractive.
All right, wonderful. Well, now to wrap things up, I'm going to ask you to give us maybe a 30-second recap on everything we talked about today. I know that's a lot to fit into 30 seconds, but your best advice on growth capital.
Think through, where your capital needs are for the next 24 months. Realize that the institution that you may or may not be, what's your experience has been with them for the last 12 months, that whatever it is, it's probably going to repeat over the next 12 to 24 months. So if that's been great, they're probably going to be a great partner. If it's not been great, the relationship's probably going to repeat itself moving forward. So think ahead of your capital needs. The process takes us about 4 months, as I said, on the average to max 6 months, and put yourself in the right position to continue to execute on your strategy and bring on the right capital partner today to continue to grow.
Great advice. And Diwakar, always so good to have you back on the show with me. We appreciate that you're able to give us a full picture on understanding credit, especially when it comes to growth capital.
All right. Thank you for having me.
Well, we covered quite a bit here today, but as you might have guessed, there's a lot more to consider, and Polaris is here to support you. So go ahead and reach out, and we'll be happy to set up a call. Also, if you'd like to learn about any of our Polaris expert advisory services, or maybe there's a topic we haven't covered that you want to hear about, you can send us an email to info@polarishealthcarepartners.com, or you can reach us by visiting our website at polarishealthcarepartners.com. Thanks so much for being a loyal listener and subscriber. If you enjoyed today's episode, please share this episode with a colleague, and be sure to leave us a rating on Apple Podcasts, Spotify, iHeartRadio, or wherever you get your podcasts. We'll see you on the next episode of the Group Practice Accelerator Podcast.